Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to us by EQ Derivatives. Our topic today is on using the Nasdaq 100 Volatility Index to create NDX iron condors. And with us this afternoon, I'm very pleased to have Russell Rhodes, CFA and Head Research and Consulting at EQ Derivatives, Inc. Russell's been a favorite webinar presenter for quite a few years, and you can find any of his previous presentations also available on our website. But right now, if you would, join me in welcoming Russell for today's presentation. Russell, I'm passing you those controls, so if you can share your presentation, let's get underway here this afternoon. Thanks for joining us, Russell.
Okay. Well, yes?
I was going to say, there it is, and it looks terrific.
Yay. Look at us. We were almost like a well-oiled machine there. So as Cynthia said, I've been doing webcasts with Interactive Brokers for well over a decade now. And we don't tell other brokerage firms this, but I've also been a IB client since 1999. That's always been my favorite brokerage firm. And I also find that traders that trade through IB seem to be a little bit more sophisticated, so I always enjoy doing the webcasts with you guys. Today we got bigger numbers than I'm used to. I'm going to do my very best to get to all of the questions as they come along. If we, as Cynthia mentioned, if I do skip over a question, I'll circle back to it, or it may be something that's getting ready to come up. But I feel like I usually do a pretty good job of covering all the questions over the course of the hour or so that we have today. Also, at the very end of the presentation, you have my email address if you're watching this as a recording, or something hits you in the middle of the night about NDX iron condors or NDX even credit spreads. Do not hesitate to shoot me an email over at EQ Derivatives. Also, I think we've spent enough time. I threw my disclosure up there as I was doing some intro material. I am here for educational purposes only. Definitely do your own work and see how what I'm going to talk about today trades before maybe you dip your toe into the water with these types of trades. So I'm going to start out and I'm going to talk about the Nasdaq 100 for just a minute or two. There are a few things around the index I think everybody's familiar with. There are a couple of things that I definitely want to point out with respect to the behavior of the Nasdaq 100 index and the Nasdaq 100 Volatility Index, which trades under the ticker VOLQ. There is another version of the Nasdaq 100 Volatility Index or a volatility index based on the Nasdaq 100. The ticker is VXN. I'm actually working on a piece that will go up on EQ Derivatives in the next few days that highlights the differences between the two. I'll discuss the differences between the two today as well, just so I can understand why the price levels are sometimes very different between those two. I'll talk about how NDX versus QQQ, the triple Q options, are basically based on the same price performance as the Nasdaq 100. There's about a 40-to-1 relationship there. In fact, I was working with one trader that had never traded options before that wanted to take a look at what I'm going to talk about today. And I suggested that they actually think about using QQQ options first, just to get a feel for how this works, as well as not put too much money at risk when you're trying this out. I'm going to talk about how I use VOLQ, or any volatility index that is, to convert to a one-day price projection. There's a real easy way to do this. And then there's get out the spreadsheet and figure things out process. I like, if you're actually going to use the one-day price projection, you probably want to be a little bit more exact. And then I'll talk about a trading approach that I've run through and back tested, and then been trading for a few weeks just to see how it works in the real world, that uses VOLQ to basically dictate what strikes we use, what short strikes we use when we're putting together a iron condor. And like I said, I'll do my very best to field questions. I and again, have my contact information up on a slide, and you can download that as well as a PDF. So the Nasdaq 100 is cap weighted. We always hear how one or two stocks when Nasdaq's having a big move in one direction or another, really around earnings season. We'll hear how a company like Amazon or maybe Google is pushing the index in one direction or another, or having a big influence on the index in one direction or another. I had always thought about the Nasdaq as kind of a Nasdaq 100 as kind of a technology and biotech index, but due to some companies that have listed on the Nasdaq, the second biggest weighting for industry weighting in the Nasdaq 100 is actually consumer services now, which I've found somewhat interesting. Biotech's a close third, but 22% is consumer services. The 2020 has been a really good year for the Nasdaq 100. I think just the fundamentals the fundamental environment that goes along with the unfortunate world situation that we've been in, working from home, shopping from home, has definitely been a beneficiary to some of the bigger companies in the Nasdaq 100. And speaking of those, here's the top 10 holdings as of last week and a rough estimate as to how much, what the weighting was. Or Google, where I've got the Goog and then L. There's actually two versions of Google stock outstanding. I summed those two together to get the top two holdings. Both of those are actually in the Nasdaq. And for the most part, I would say 8 of the 10 stocks on here definitely benefit from the work from home trend. Tesla would not be one of them, although Tesla has done quite well over the last 6 months as well. So you can just see why the Nasdaq 100 has been a huge outperformer this year, based on, really just based on the types of companies that make up the Nasdaq 100. So the index options are like the other broad-based index options, like the Russell 2000, the S&P 500 options. They're based on a multiplier of $100, which with the Nasdaq up, at very high levels, puts the notional value for the underlying notional value for one NDX option at a pretty, at a pretty high level. The options are European style, which may not be exercised early, something that institutions like an awful lot. And the expirations do occur on Monday, Wednesday, Friday, with the non-standard old school with the standard third Friday options. It says non-standard. That should say standard third Friday options, with the non-standard options settling on the close and the standard third Friday options settling in the morning, the day after trading ceases. And this will show up a little bit better with a table that I put together here. I took the expirations that were available as of a week ago today, August 11th, which was my due date for this webcast. And everything that's blue on here, which is Monday, Wednesday, Friday, along with really it's just the Monday, Wednesday, Friday, excluding the third Friday options. And then you can see as we go farther out in the expiration calendar, you can see that those are all AM settled contracts. And I really wanted to highlight the AM settled contract situation, because I'm going to be talking about one-day trades where you put a trade on a Tuesday and you hold it, which today would be the Tuesday, and you hold it through Wednesday expiration. Well, do keep in mind that if you look to do something like this on a Thursday for a Friday expiration, if you're looking at the Thursday before the third Friday, it doesn't make a whole lot of sense to approach the doesn't make a whole lot of sense to use that approach. So the contract size, and I just rounded NDX to around 11,000, where it was this time last week. The notional would be $1.1 million. The Qs, with the Q at about the QQQ at about 268.50, we will we've got the notional of $26,850 for that one. I actually did get a question from Stephanie asking about the size of the contracts, and she's asking about the micros. There are smaller versions of the NDX available. When you refer to the micro, you're actually referring to the futures contracts that trade at CME Group. There are going to be options launched on some of the micros at the end of this month, and I'm not 100% sure if Nasdaq is one of those markets that they're going to launch the options on. But there are smaller versions, or there are smaller contracts available than the big NDX option. However, you'll see in a minute, even though it's 1.1 million, the potential downside for trading a one lot, what I'm going to talk about, is not nearly, sure not $1.1 million. It actually comes to about $1,500 or so for a one lot. So don't get overly intimidated by that 1.1 million notional contract. And again, the micros, the new micro options on, or new options on the micro futures, I think are launching maybe August 31st, but I do believe it's by the end of this month. And just again, one other thing to throw out there is the difference between NDX and Qs. I just got a couple of questions about NQX. Yeah, NQX options are available as well, which is a smaller version of the NDX options. I probably should have included those on the table. So just one other big difference between NDX and QQQ, and actually one of the reasons that I prefer to use index options for this one-day trading strategy. The Qs are actually physically settled, and last week actually, using this approach on Tuesday through Wednesday expiration, the short call strike was in the money on the close, and that actually, but the long call strike was not. If you had done this trade with QQQ options, you would have you actually would have had a long position in the Qs come Thursday morning if you held this through, if you had held that trade through the close. So switching over to the Nasdaq Volatility Index, or VolQ. Now the VolQ is actually, it's a like just about every volatility index out there, VIX or the Spikes, which is based on SPY options, or RVX, which is based on Russell 2000 index options. You're getting a 30-day or market's expectation of realized volatility over the next 30 calendar days. That's the one thing that they all have in common. VolQ actually, it uses something, a methodology that Valdex came up with, which is kind of interesting. What they do is they actually use 4 expirations instead of 2, and they bracket that 30-day time frame. So there's 2 expirations before 30 days and 2 expirations after 30 days. And with those 4 expirations, they will use the first and second in the money and out of the money call and put options. This results in 32 option contracts being used to come up with this 30-day expected volatility measure. And you can learn more about the Valdex methodology at NationShares, which is nations.com. And our buddy Scott Nations was actually instrumental in coming up with this methodology. Now, I did throw out there that there's VXN. I did recently do a quick comparison of VolQ versus VXN, and typically VXN is at a higher level than VolQ, and that's just because VXN uses farther out of the money option contracts than VolQ does, and at the money implied volatility, especially on the put side for broad-based index options, is typically lower than out of the money implied volatility. So typically VolQ is a little bit lower level. Actually, VolQ's price level is usually pretty close to VIX, sometimes at a discount and sometimes at a premium to VIX. Now it does measure measures that implied volatility, and it reacts in a way that you would expect from a volatility index based on a broad-based stock index. And if I didn't put labels on here and just showed this chart, anybody that pays attention to the volatility markets would comment that, well, that looks like VIX in the S&P 500. Well, it can look like V stocks and the Euro Stoxx 50. They all have this similar inverse relationship that you're used to. In fact, I think the inverse relationship over the full life of vol Q, which we have data going back to 2014, is about minus 0.75, minus 0.76 on a day-to-day basis relative to the Nasdaq 100. Now that's very close to the inverse relationship between VIX and the S&P 500. So the point is, vol Q actually acts very similarly to the way that VIX reacts relative to its underlying market. So shifting over to doing a little math here, and I just used the trading example from April 7th when vol Q was at a little bit elevated level. If you took vol Q at 40.61, and this is on the close of Tuesday, April 7th, and the Nasdaq at NDX at 80.49, man, we've come a long way since April 7th. You could convert that vol Q, dividing it by the square root of 252, and this is how I like to convert implied volatility to a shorter term move when you're looking at options that just have a few days or even 1 day left to expiration. So I use the square root of the number of trading days in the year, and you get about 2.56%, which means that a 1 standard deviation move for the NDX based on vol Q would be up or down to 0.56% the following day. Now, using that 2.56% number, we can actually get a rough idea of, if we don't have strike prices of 78.43, 25 and 82.55, 82.55, 37, but we have strike prices that are within a few points of each of these. In fact, the NDX options tend to move in increments of 10 points or so. So based on the vol Q of 40.61, NDX at 80.49.31, we've got with 1 standard deviation certainty, about 2/3 certainty, that we would expect NDX to land between 78.43 and 82.55.37 the following day. So using that, we can take a look at selling the 78.40s and selling the 78.40 calls and the 82.60 puts as part of an iron condor, and that's how we would start out with the iron condor. And based on market pricing toward the end of the day on April 7th, we could have sold the April 8th for 78.40, or I'm sorry, the 78.40 for 28.80, and the 82.60 call for 16.60. Those are pretty high premiums when you think about it. And then what I did, and this is arbitrary, and I know for a fact that there are other entities that read my write-up on this and are doing things slightly different, but we could buy the 78.20 put and buy the 82.80. That should be the April 8th 82.80 call. When you sum all these together, taking in credits on the 2 options you sold, paying out a little bit for the 2 options you purchased, we get a net credit of $565. Just for commission and whatnot purposes, I actually add a dime in there, and adding that dime in there means that we get a net credit of $555. I put that in there because I know some people that do math really quick would be able to see that the actual credit was $565, but I just like to put a little bit extra slippage against what I'm working on when I backtest these sorts of things. And so this trade, again, it actually worked out pretty well. I actually did not put a payout diagram in here on this one, but your maximum potential loss in this case, using the slippage number that I give you, would be 1445. So as I mentioned earlier, we've got that $1.1 million underlying notional right now based on the 100 multiplier and Nasdaq around 11,000. However, trading a one lot with the NDX options in this manner results in a loss, a potential maximum loss if we had a big outlier move in NDX of $1,445 or $1,445, which is not, it depends on your budget, but I don't think is nearly as scary as just looking at the high level of NDX when I was doing the NDX versus Qs comparison. Now, what led me to using Tuesday options for Wednesday, just to hold through the Wednesday close, came from this. And what I was doing was I was taking a look at the predicted one-day move for each trading day using vol Q versus the number of observations that we have going back to 2014. And I've highlighted Tuesday here. And basically, the observation that we had 336 Tuesday to Wednesday closes, and almost 77% of the time, the market closed within that upside and downside. So if you can consistently put trades on that, make a little bit more 3 times, then it loses that 4th time, you actually might have a nice consistent method of trading index options or trading any option. And in fact, all option prices do is give you an idea of what the market is predicting. And in this case, NDX options, again, based on vol Q, NDX options are overpriced for a one-day move, most often on Tuesday. Now they're overpriced, and I thought it was really interesting that they seem to be most underpriced on Friday going into Monday. And I have a few theories on that. One is I think that the implied volatility is a little bit depressed on Friday afternoons because market makers are starting to adjust for weekend time decay. So that might be why we see that low number on Friday. I'd have to actually maybe put a little bit more pen to paper and see if Friday to Monday trades would work out. I do know that there have been some entities that have been taking a look at doing Thursday to Friday trades. But my favorite out of all of this was really taking a look at Tuesday afternoon, putting on an iron condor, basing those strikes on vol Q, and holding that trade through the close on Wednesday. Just holding them through that cash settlement on Wednesday. So I did testing. I was able to grab data pretty quickly from January 2019 through June of 2020. Had 76 observations. Used vol Q to give me an idea of what the short strike should be, and purchased the put and call options that were 20 points farther out of the money from the short strikes, and just held through the close, the cash settlement on Wednesday. Didn't even have to worry about trading out or anything like that, which is something that you have to do when you're looking at ETF options. So based on this look back period, we had 76 trades, 61 winners, which is 80.26%. And the reason that number is a little bit higher than that 76% number that I showed you before is I always go a little bit farther out on the strikes, like I did in the example just a minute ago. So if the one standard deviation move to the downside gives me 78.43, I'm selling the 78.40. Also, the reason that win percentage is a little bit higher than 76%, there's a couple of instances where the NDX closed outside a short strike, but it was so small that the credit you took in still resulted in us seeing a winning trade. Now, the total profit behind doing something along these lines was 88.56 points. The biggest gain was 995, right in the middle of what was going on crisis-wise. In fact, we had a very wide spread, but we also had very high premiums, which resulted in a pretty decent profit. The longest win streak, this actually worked every week from October 8th to February 25th. The biggest loss was 1 week after that big gain. I thought that was kind of interesting, at a loss of 1775, and 3 times there were back-to-back losing weeks. So I thought that all of this was pretty interesting. And again, these results were through June 30th. And then what I started doing was I actually started trading this late on Tuesdays to hold through Wednesday. And since then, I've had, I believe, 6 trades, and 5 of the 6 actually worked out since then as well. Last week was actually the first loser since I've been paying really close attention to this. And it was a small loser that barely overwhelmed the amount of premium that we took in. This is just a running P&L on that Iron Condor. You can see that there are some periods where it works particularly well. You can see that nice win streak from about the middle of the chart through March. It started to zigzag around. It's actually started to work its way back up since June 30th. And I wrote this up and posted it at EQ Derivatives. And as always, I opened myself up for questions and commentary and shared my email address. And one question that I got multiple times was, why buy, if you're going to win that much, why buy the 20-point out of the money put option and call option? Why don't you just do the strangle? Well, one reason is you could experience some ridiculous drawdown, and we'll see that in just a second. And I'm very much into risk control, but so this is if I could put another disclosure statement or disclaimer right in the middle of a webcast, this would be where it goes. But I am going to show you how this would work doing one-day short strangle trades. And over the same time period, basically just selling the one standard deviation, put option and call option with no protection whatsoever. And choosing the short strikes in the same way, held the trade through the close on Wednesday. And before we look at anything else, look at that big loss. That's minus 124.17. The biggest gain was pretty substantial as well, but the longest win streak was really nice. There were a couple of losing streaks. We have a higher win percentage because you've got because you're just selling and taking in premium. You've got a much wider range of potential profitability. And the total profit is very nice as well. But again, that big loss of 124 points, that's a $12,417 loss. In intraday, I think it was even worse. Just take that to heart. But again, I did get the most common question I got after I wrote this up as an article was, how would this work as a short strangle? And here's the P&L guide as well. You can see that big loss on 317. There's another big loss back in August of 2019, and a smaller loss back in January of 19. So I just cringe a little bit at even showing that. And I've probably reached the point now where I've offered so much caution that somebody's going to send me an email and say, who the heck are you to tell me how much risk I can take on? I've warned vehemently on this one. Very nice long-term profit. Pretty difficult drawdown there. In a couple of drawdowns there over the course of selling those strangles. So other things to think about. And I see a couple questions, and I'm going to jump on them. There, Stephanie just hit on one of the things. Wider wings. I used 20 points just as a very arbitrary number. I tried 10 points, and I didn't like the small credit relative to the potential loss that I took in. That's where I kind of settled on 20. I didn't try other widths, although I have seen you can pick up on block trading activity, and I've seen a couple of block traders that are using 30 or 40 points, and then you could add a trend detector to determine market direction. I've done this sort of trading before with SPX options, and I found that shifting the short strikes around or even avoiding one side of the iron condor based on if we were in an uptrend or a downtrend seemed to help. I did do a little work with this system, and nothing really, a trend indicator did not help with respect to this system. And then one last thing is taking a look at what the at the money straddle or strangle is telling you implied volatility wise. I can tell you that the wings would be more narrow if you use at the money implied volatility. One of the reasons I like to use the 30-day volatility indexes and convert them is, for the most part, the historical data on volatility indexes is pretty easy to get. So, and then I just got a comment. Did you test 2 times away from the daily implied? I did not on this one. One thing that I've done is I've actually found if you use a half standard deviation as opposed to 1 standard deviation, your win percentage goes down, but your profitability actually goes up a little bit. So that's something that you might want to consider as well. It's just multiplying 0.5 times that 1 standard deviation move. So those were my things to consider. I'm going to start backing up through questions now, but I did write this up for the Nasdaq blog site. I have done a follow-up. I did a follow-up last Friday on seeing some of the actual trades that are being done using this approach, which was done a little too late to include in this webcast, but everything that I write for Nasdaq goes up on the blog site, or using NDX options. Anything relative to vol Q will go up on the Nasdaq blog site as well. They allow me to put things there. So that's a good place to monitor. Whenever I put something up on the Nasdaq site, I tweet it out. Just about any time I do something that I think people might find interesting, I'll tweet it out. There's a couple of things that I'm looking at relative to the markets and leading up to the election that I'm going to put out there in the near future as well. And as I mentioned, if you've got follow-up questions, don't hesitate to use that email address. Do give me a day or two to respond. Sometimes I get a little bit behind on things. I'm also a professor at Loyola Chicago, and we're doing back to school right now. So have a little bit more patience with me if I do that. Stephanie has been very nice and said a lot of things. Said I've read your books. I need to reread them. I'm going to be shameless. I've got a new VIX book coming out at the end of October. So keep an eye out for that. I'm going to start working my way backwards just to make sure that I hit all the questions that have come up. Let's see, did I test the Condor and strangle it 2 times away? I kind of, hold on. I'm in the trader workstation right now, and NDX only shows a 2-day. I don't see a 1-day. Thomas, we'll come back to you because that's a Cynthia question, and I'm going to talk for a minute, and then I'll let her come on. But I definitely want you to talk to you about that. I have seen. I think I know what's going on there. I had a little bit of difficulty finding the Wednesday expirations initially. I think what you're only seeing are the standard expirations, and there's a way to make sure you see all expirations. I just can't remember how to tell you how to do that. But Cynthia will give you some guidance on that. I encountered that exact same problem the first time I tried to trade this. So there. So if I ever have to, I guess I can become an interactive broker help desk person, at least on the option side. Let's see. 2 times away is the daily implied vols as well. I'm going to do that. I tried a half and it was okay. I did not try 2 times the daily implied volatility, but that might be kind of interesting. I do know that I got more than a 2 times move a couple of times. So the win percentage would increase, but I'm not sure what it would do to the profitability. The trend indicator that I just kind of mentioned in passing, it's actually nothing more than the closing price versus a 20-day moving average. I tried a lot of different things, and that really for short-term overnight trades like this, honestly, the 19-day moving average was best, but I think 20-day is a pretty good, nice round number to work with. Did I try stop loss when I was testing this? I did try some stop losses, and I'll give you a prime example of why I'm better off holding this. I think it's better off just to go ahead and hold this. Last week, I was watching the trade very closely because it was the first time the trade did not work perfectly. And at one point, I could have closed out the trade for right at a 100% loss, which would have been, I think I took in about 425 or so. And there was a point where I could have taken it off for a loss of basically at 850, which when you take out the 425 that I took in, you basically would have a loss of 425. Having held it through expiration, as I did, I ended up having a loss that was less than that. So trying to manage the trade or put something in there that's a stop loss, I found that I got whipped out a little bit more. One of the things that I like about iron condors or vertical spreads, I actually think of the maximum loss as my stop loss, which I know more active traders like to manage those things, and I've received doubt when I say things like that in a public forum. Say, you really going to get run over by that? Like, you know, I get run over every once in a while, but I don't get whipsawed out of a position. So I'm not a big fan of using stop losses for these types of trades. I'll use a stop loss if I'm doing something that's more of a directional trade, like buying an option and hoping that the underlying moves in a certain direction. But for iron condors or vertical spreads, I personally have not found a lot of success trying to use stop losses. Also, I'm not watching the market 24/7 or all trading days, so trying to use a stop loss, I'd probably miss things because I don't like to leave those types of trades hanging out there. Paul is asking, it says, I like to do credit spreads and iron condors on the Qs. Well, one, Qs don't have the Wednesday expiration, and this is a Tuesday to Wednesday trade. That's one reason. The other is, again, I mentioned last week's trade where one of the short strikes was in the money. I would have needed to be around at the close to make sure I traded out of that, so I didn't take delivery of the Qs. So that's, but I do think if you're going to test something out and see how it works in the market, there's nothing wrong with using the Qs. But when I'm putting things out there that I'm planning on holding through expiration, for better or worse, I like the cash settlement of the index options. That's really my preference for NDX versus the Qs, SPX versus spiders, RUT options versus the IWM. I mean, it doesn't matter which market that is. Got a question about maybe buying these as opposed to selling these. What I actually did do, I'm going to back up a little bit here. I share 2% of all the testing I did. One thing that I did do was I looked at Thursday to Friday trades because that total percent inside was lower. And when you figured the cost of trading and other things in there, it just did not work out. And I looked at Friday to Monday trading because we have Monday expirations on NDX and doing something that's a bit opposite of what I've shown you, which is looking for a move inside of the two strike prices. And it just, I just didn't find anything that worked particularly well. The best I found was a slight winner, that you'd take on 2-3 months of losers, and then you get one big winner, and then you go back to grinding lower, which I think is very mentally difficult to do, just on a consistent basis as well. I think there's some other trades that I've been working on that allow you not to lose too much and wait for the big move. Straddle strangles, or taking the opposite side of an iron condor just doesn't work particularly well. So let's see, I'm going back. So I got a question about the vol Q on Yahoo Finance. I know that you can't get the history there. I'm not sure where the history is offered publicly. I actually got the numbers from Bloomberg, which I know is not particularly helpful. What I'm actually going to do is I'm going to pass on to the folks over at Nasdaq and at Nation Shares that it probably would be in the interest of promoting people looking at VolQ to make sure people can get that data publicly. I'm going to pass that on as a suggestion. So there. And now I'm going to work back forward and NDX options. Oh my goodness. Sorry, I've lost my spot with how did I use the 20 points? I used the 20 points for, it was just kind of an arbitrary number, and things tended to work out particularly well using 20. I used 10 as well, and I didn't like the results as much because the risk reward was, you were looking at making maybe $1.50 and losing $18.50, and you were experiencing more loss, more periodic losses. So the 20 points was kind of a happy medium for me. So that's why, and then I did get the question about Delta. I tried using Delta a little bit. It just, I just couldn't find anything that consistently worked well. And the Delta for out of the money options contracts sometimes starts to be a little bit suspect. So, that's where I ended up coming up with the consistent 20-point number. So there. Would I adjust the strikes if it's looking like it's going against me? No, I don't necessarily do that I would not do that with this trade because it's a one-day trade. That's with the the one day. Since it's a one-day trade, I'm not really looking at it, and I'm putting the trade on late on Tuesday, pretty close to the close. A good portion of the move that we get the underlying occurs overnight. So, and then you're also suddenly experiencing some pretty rapid time decay, which is what benefits this trade when we don't get the big overnight move, but would make managing something like this difficult. Now, if I've done 1 week trades in other markets, and when I do that, I will have a price level in the underlying where I may consider rolling down or rolling up based on something that looks like it's starting to trend against me. But for this strategy, the answer would be no. I just got something that says SIC VXN. That's a slightly different index than the one that I'm using here. I did get a question about where do you get the VolQ quote. I actually use Yahoo Finance to get the actual quote, but not the historical data on it. And then those 20 points, that's really just arbitrary and not necessarily the delta. I've got a question about the NDX option expirations, which I'm going to let Cynthia jump up on. Jim is asking, how does this work with SPX and RUT? It does, but it works best with NDX Tuesday to Wednesday. But for SPX and RUT, for SPX, I actually had a lot of success doing something similar, but for 2-day holds. And I was only looking at Friday expiration, so I've got to dust things off. And it works somewhat well for the Russell 2000 and using RVX to pick the strikes, because I think this works better with a higher volatility market, and RVX is consistently higher than VIX based on the S&P 500, or VolQ and VXN based on based on the underlying. Do I use the mid price, or am I shooting for the mid bid and ask? What I actually do when I execute these trades, I take the bid ask spread of the natural, which would basically be the bid prices of the inner strikes and the offer prices of the outer strikes. I figure out the midpoint and I give up 10 cents, and I'm usually getting filled about there. So sometimes I've got to move another dime or so, but that's how I actually go about executing these. I am kicking myself right now for not including an example where I go through how I actually executed one, but I should do that. And then I just got a little note from Sunil, said, "Thank you, Russell." Well, thank you. I greatly appreciate the people that have stuck with us here. I think I've gotten all the non-platform questions, and I think I hear Cynthia moving around a little bit.
Absolutely, you do. I see those questions on how to find those non-standard options. So what I am going to do, sorry, Russell, I just grabbed the controls back again, is take you into the Trader Workstation. Now, let me see here what I'm going to do. You'll see my TWS is open on the top of your screen, and you'll see that I do have an equity that's included here. Now, notice in the upper left-hand corner, you'll be able to see the expiration dates. Initially, you may see just the monthly expirations, but underneath the More button, you'll also find the weekly expiries are included here. Now, these are all expiring on the Friday, whether it's the weekly or the monthly. Now, how do you access for let me see, for the indexes? Well, what I'm going to do is I'll simply close out here and bring up the NDX. Now, when I do bring up the NDX, I'm going to go to the options chain. Now, I can do that either from the order entry window or go directly underneath the new window button. You'll find the option chains are included underneath the option tools. Now, once we launch the option chains, notice how it will populate within this window. We'll see, and this is what everyone is talking about, is that they do see the upcoming expirations. If you want to take a look for the weeklies, notice here, or you'll see, first of all, these are what's available for NDX coming up August 20th and then again on September 17th. But also, I do want to point out there is a trading class drop-down menu over to the far right within those option chains. And on here, if you do click, instead of choosing the NDX, go into the NDXP. Notice all of a sudden you get those additional Monday and Wednesday expirations will all become available to you. The key is to go in and choose a different trading class. Now notice when I go into the More button, you'll find those Monday and Wednesday along with the Friday expirations will be available as well. So I did want you to see it's all within that trading class menu for any of those index options that we do have available. So keep that in mind, and I'm going to send it back over to Russell to wrap up for any additional questions that came in. So Russell, we'll go back to you right now.
Okay. Yeah, I knew it was a little. I would not have been able to walk everybody through that. I remember I found it, and once you set things up the way that Cynthia just said, you don't have to do that every time. So now when I go to when I pull up my screen to do my NDX trade, I'm not having to go through all that trouble again. So there. I do not see any other questions. I think we're pretty good on all this. We can, actually one person is asking if you can show the drop down once again. And somebody did, and I did miss this question. How about the volume? The thing with volume on a market, on an option market, is it's really based on the volume in the underlying hedging vehicle. And the underlying hedging vehicle for this is for these, believe it or not, are actually the Nasdaq futures contracts that trade at CME Group, and that's a pretty liquid contract. So when you try to put something in, the quotes that you see might not be are really indicative of a big size type trade that would go in. You can usually do much better than that. And I don't worry too much about the volume of individual options. I always watch the volume of what the hedging vehicle is. And usually for stock options, it's the underlying stock. But for index options, it's typically the corresponding futures contract that the market makers are using to hedge themselves. Kevin, I actually, he's asking about the square root calculation. I actually just put the numbers into a spreadsheet that I open up. That just I type in vol Q and I type in the NDX, and it gives me all of those answers. And I use the square root of 252.
Okay, Russell. Just before I did want to, while you've been talking, I've actually pointed out in the option chains, and by the way, if you use the TWS option trader from the classic version, you'll find that trading class is also available on that screen. You're looking for the trading class drop-down menu and simply change to the NDXP, and notice here how you'll get all of those additional expirations. So they are available, just a couple of extra clicks to get to it. So what I'm going to do, if you still, I have your contact information up rather than passing the controls back over to you. So are there any additional questions you want to get to?
Well, do you guys have vol Q quoted on the Trader Work session right now?
I would have to take a look. Let me see. Let's see. Let's get back in here.
If not, you're gonna need to, because vol Q futures are coming out in October from CME Group.
Oh, I'll have to look at it, look it up. I'm not sure if I have the permissions for this, but I will check on it.
Okay. But if you don't, I wouldn't be surprised if you guys do in the near future, again, because futures are coming out on vol Q. Right now they're looking at October 5th, and CME Group's doing that. And don't be surprised if options on vol Q get offered before the year's out.
Ah, okay, that's good information.
So if it's not, Cynthia and I are going to beat up on people, so it will be. How's that? And
okay. Oh, I also see there's a question. Is there, well, you've already answered it, but I do want to remind everyone we have been recording today's session, and each of you will get a direct link to today's recorded playback, as well as a PDF copy of Russell's slides later on this afternoon. As soon as that recording becomes available, you'll all get an automated message with those links. By the way, also notice on the right-hand side of your screen in the control panel, there's a handouts pane. Simply double-click that title bar and you'll find a PDF copy of today's slides is available for you, and you can download directly from here before you do exit today's presentation. So with that, looks like we are going to conclude our event today. I also want to let you know that Russell has agreed to come back. We're just settling the September webinar schedule, and Russell will be talking about spread trading volatility expectations coming up on September 8th. So we'll have that listed very shortly, and I do hope you come back and join us at that point. So once again, thank you very much, Russell. Always a treat to have you on our webinars. Can't wait till we connect one more time. So with that, we are going to conclude our session here this afternoon. Great deal of thanks to Russell Rhodes and to EQ Derivatives for making today's presentation possible. You can all exit the session using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone. See you next time. Thanks.